Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss the impact of stock market concentration on trading strategies.
Hello everyone, my name is Radovan Vojtko, I'm head of research and CEO at Quantpedia. Today we will discuss everybody's favorite topic, and it's Bitcoin and cryptocurrencies. Of course, everybody knows what's in the news, so Bitcoin is close to its all-time high, so close to 63,000 US dollars now. Everybody has some ideas how much of the Bitcoin you should have in your portfolio. There are a lot of evangelists who suggest that you should forget all other investment products, all other possibilities for investments, and get all of your money into the cryptocurrencies and buy as much Bitcoin and cryptocurrencies as you can. Let's take a look on it from the quantitative point of view. We wrote an article, it's titled How Much Bitcoin Should We Allocate to the Portfolio? And in this article we did a quantitative analysis of how much Bitcoin you should have in your portfolio. Here we have a chart from 2014 to 2023, so for the last 10 years, so it's until the end of the year 2023, but we are in the February 2024, but the analysis doesn't change at all. What we can learn from the data, so we can see that, of course, cryptocurrencies had extremely high return of over 100% over those 11 years. They had significant volatility, 83%. Maximal drawdown around minus 82%, Sharpe ratio of 1.25, which is, really interesting Sharpe ratio compared to all other asset classes. What we think and what we believe is there are two important periods in the whole 11 years period, and we can split this chart into two halves, and we can split it on December 10th, 2017. What happened on December 10th, 2017? So very important thing, the Chicago Mercantile Exchange started to trade Bitcoin futures. So at the time, institutional investors had very interesting way how to access the Bitcoin market without, need to open accounts in some unregulated and very often very shady crypto exchange and to send money somewhere else on the other side of the world to somebody, who did they not know at that moment at all. It's Bitcoin future. It helped financialization of cryptocurrency markets. That's a term that describes that when a market becomes integrated into the broader financial system. And at the time, the Bitcoin gained characteristics similar to traditional financial assets. That's not the first time something like that happened. So, the cryptocurrency market mirrored similar developments in emerging markets and commodities. So once before they were considered obscure asset class, but those asset classes, they underwent the similar transformation. Initially, there were only specialized funds that were invested in those markets. In the middle of 2000, there were indexes that were introduced, ETFs that were introduced, and those markets, the commodities and emerging markets, they become more accessible to the mainstream investors. It has impact on those markets, and there is also impact on the Bitcoin market. The similar path can be expected for the cryptocurrencies. We should understand that there is the landscape has changed, and we should adjust our strategies. So let's take a look on the Bitcoin and take a look on those two different periods. So before the financialization and after the financialization. So let's take first a look on the chart until 2017. So until 2017, the crypto market was extremely young. It was mainly populated by people who really understood the market or some first pioneers. So at the time, the Bitcoin had extreme performance, 280%, Sharpe ratio nearly 3. But now let's take a look how does the chart looks from 2017. So from the time when the first Bitcoin futures were introduced, what is the performance after that? So it's 22% with 70% volatility, Sharpe ratio 0.41, maximum drawdown 80%. So yes, we still have performance around 20%, but with 80% drawdowns and 70% volatility. Bitcoin's return or risk to return ratios in the post-financialization period, that's the period when the Bitcoin and cryptocurrencies started to become the mainstream, are nothing spectacular. They have the Sharpe ratio 0.41, Kalmar ratio 0.28. So the question is, how much Bitcoin should we allocate to the portfolio? We did the following analysis. So we took 9 main asset classes. We tried to be globally diversified. So there are some US equities, emerging market equities, ex-US equities. There is a real estate, treasury bonds, corporate bonds, high yield bonds, commodities, gold, and finally Bitcoin. And we ran the market optimization on the period 2013 to 2017, and we found out that yes, we can have a very nice portfolio if we include the Bitcoin. That's when we have the equally weighted portfolio. So I mean, it's very nice performance with a Sharpe ratio 1.94. I mean, what you need to keep in mind is that at that time it was extremely complicated for institutional investor to invest into the Bitcoin. There were no legal tax framework, how to do it properly, etc., etc. I mean, there were all the problems with who should I send the money to obtain the Bitcoin, how should I store it, etc., etc. Here is the correlation table. So as we can see, the Bitcoin had zero correlation to all of the other assets. So when we use the Markowitz model and we ran the Markowitz model and we looked for a tangency portfolio, the tangency portfolio gave us the information that we should invest nearly 15% to the Bitcoin. And this tangency portfolio would give us approximate 50% return with a 15% volatility and Sharpe ratio over 3. So I mean, at the time, investment in the Bitcoin extremely helped to your portfolio, but it was before the financialization, 7 years before. So this period ended in 2017. Then we ran some risk parity. Let's move on to the period after the financializations. So I mean, after the Bitcoin futures are introduced, after the Bitcoin ETFs were introduced, and I mean after the Bitcoin spot ETFs were introduced, which is like a month ago. What is the equally weighted portfolio return? Return is significantly lower. Sharpe ratio is significantly lower. Then we ran the underlying component analysis. What is the performance of all of the underlying ETFs and Bitcoin, of course. And as we see post-financialization, the Sharpe ratio of the Bitcoin is 0.41. I mean, it makes it an average asset class. It's outmatched by S&P 500, it's outmatched by commodities, by gold. I mean, it's approximately the same Sharpe ratio as a high-yield bond, ex-US equities, or US real estate. Bitcoin had a higher performance, but was the most risky asset in the whole portfolio by a high margin. So yeah, you will get more return, but you will get more return even when you buy S&P 500 and use leverage. Now the question is, what is the correlation? We ran the correlation from 2018 until 2023, and the correlation changed significantly. The average correlation is around 0.2. So we moved from zero correlation to 0.2 correlation. The highest correlation is with S&P 500. Of course, we have a lot of articles that show that the beta of the Bitcoin is mainly the beta of the small technology stocks. And S&P 500 is mainly the technology index. So we applied the Markowitz model and we analyzed portfolio from 2014 to 2017. The tangency portfolio showed us that the optimal allocation is over 14%. So that's until 2017. So what happens when we run the same Markowitz optimization from 2018 until 2023? So the tangency portfolio suggests allocating only 2.94% to Bitcoin. And that's probably the optimal value you should have in cryptocurrencies, so between 2 and 3%. I mean, this adjustment reflects the changes in market conditions. So what does it mean is that we have higher correlation, there is high risk, and I stay by that. There is significantly lower expected return in the future for the Bitcoin or for cryptocurrencies than it was before, because right now they are one of the main asset classes. They are heavily entrenched into the traditional finance, and there is a lot of arbitrage going on between the cryptocurrencies and traditional asset classes. We cannot expect returns that were before at all. I mean, never. It will never happen again. So then we run the risk parity. We try to find out what is the optimal outcome. So how much Bitcoin should we have if you want to have the same risk in all of the asset classes. Once again, the risk parity strategy gave us approximately 2% allocation to Bitcoin. I mean, this adjustment reflects that the Bitcoin is really, really volatile and really, really risky. Yeah, it can have interesting performance, but you can have interesting performance also with other asset classes with a lower risk. So we are not telling not to buy Bitcoin. We are okay with the Bitcoin. We are okay with cryptocurrencies. They are, I mean, mainstream part of the financial ecosystem. They are mainstream part of the investment portfolios. What we are against is to have very, very significant part of the portfolio invested in cryptocurrencies, like something like, I don't know, 30% or 50%. I mean, it doesn't make sense at all. So you can have better portfolio when you have less cryptocurrencies, and you can have a better portfolio when you have cryptocurrencies. So I mean, really, it makes sense to have some cryptocurrencies in your portfolio, or to have crypto trading strategies like we have a lot of them in our database. So you do not need to buy crypto or Bitcoin or whatever passively. You can do that on an active basis. You can decrease the risk, you can increase the performance, or at least you can have the same performance with lower risk than just holding an underlying cryptocurrency market. So feel free to use systematic trading strategies, even some strategies from our database. It makes sense to have something in your portfolio, but I mean, it doesn't make sense to have like 30% or 50% or I don't know, 100% as some evangelists suggest. I hope that you liked our analysis. The link to the analysis is in the description of the video. I hope that you will subscribe to our channel. There is a lot of quantitative and systematic trading research coming in our channel every week. Join us, like our video, it will help us a lot. Thank you very much for your attention.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.